Everyone warned Dave. His girlfriend warned him. His dad warned him. His portfolio warned him. In red, 3 separate times, across 3 separate quarters. Dave did not listen, because Dave had a 13% return year-to-date, a meme coin that went 4x, and the unshakable confidence of a man who has watched The Wolf of Wall Street 17 times and takes notes. This is the story of how the dumbest investors in the room have been systematically beating the smartest ones for 17 years straight, and why that's not a coincidence, and why it's actually one of the most dangerous things happening in financial markets right now. Dave is 26 years old. Dave has been trading for 2 years, which in Wall Street terms is the equivalent of a toddler who just discovered fire and is now confidently giving other toddlers fire safety tips. His portfolio is up 13% year-to-date, which he announces at every social gathering, regardless of whether the topic came up. He rode a meme coin from 12 cents to 41 cents and back down to 9 cents, but he only tells people the second part of that sentence. Dave's hobbies include watching The Wolf of Wall Street, explaining emerging biotech opportunities to people at the bar who did not ask, adding 12 new tickers to a watch list he will never act on, and, of course, zinning. Dave has decided he has what it takes to go full-time. So Dave does what any rational, clear-eyed, responsible adult in his position would do. He calls his broker, significantly overstates his net worth, and gets approved for options trading. 3 months later, Dave is leveraged to the absolute maximum on out-of-the-money Tesla calls. His strategy, buy high, sell higher. His risk management framework, prayer. His position sizing methodology, vibes. His wife's primary concern at this point in time, why is $13,000 missing from our joint savings account? 3 months after that, the Federal Reserve decides to raise interest rates by 75 basis points. Dave's portfolio is now down 67% in 6 months. His wife's new hobby is Googling how to divorce a man who describes himself as a self-taught market wizard. Dave, for his part, believes this is market manipulation, which brings us to the actual question at the center of this video, the one that explains not just Dave, but the entire financial ecosystem Dave exists inside of. Why do the dumbest investors keep winning? And more importantly, why have they been winning for 17 years? There is a psychological phenomenon called the Dunning-Kruger effect, and it is the financial market's version of natural selection. The effect was formally described by psychologists David Dunning and Justin Kruger in 1999, and it describes a pattern that any experienced investor will immediately recognize. People with low competence in a subject tend to dramatically overestimate their own skill level. Meanwhile, people with genuine expertise tend to underestimate themselves, because the more you know, the more clearly you can see how much you don't know. In markets, this produces a very specific and very counterintuitive result. Dave, who genuinely does not understand what a put option is, believes he is Warren Buffett reincarnated. Marcus, who has a CFA designation, has read security analysis cover to cover 4 times, and has spent 15 years building discounted cash flow models, lies awake at night wondering if he's missing something. And the uncomfortable, infuriating, deeply unsatisfying truth is that for the past 17 years, Dave has been beating Marcus on returns. Not because Dave is smarter, not because Dave has better information, but because of a single, specific, measurable variable, something called beta. Let's get precise about what beta actually means, because this is where the whole story clicks into place. Beta is a statistical measure of how volatile a stock is relative to the overall market. A beta of 1 means the stock moves in exact lockstep with the market. A beta above 1 means it amplifies market moves in both directions. Here's a concrete example. Amazon has a beta of approximately 1.33. What that means in practice, if the overall market rises 2%, Amazon is statistically expected to rise 2.66%, and if the market falls 2%, Amazon falls 2.66%. Now, Dave doesn't buy Amazon. Amazon is boring. Amazon is for people who don't understand the opportunity. Dave buys things with a beta of 3, 4, 6, 8, meme coins, zero-day options, pre-revenue biotech stocks that have a mascot but no product. Tesla calls that expire in 4 days. In the language of professional finance, Dave has constructed what would be called a high beta portfolio. In the language of anyone watching from outside, Dave has built a machine that takes whatever the market does and multiplies it. In a bull market, a real, sustained, multi-year bull market, a high beta portfolio doesn't just beat the index, it annihilates it. It makes the S&P 500 look like a savings account. And here is the number that makes everything else make sense. Since 2009, across 17 consecutive years, the S&P 500 has returned over 715%. That is not a normal bull market. That is the longest, most powerful, most relentless equity run in recorded financial history, fueled by a decade of near-zero interest rates, multiple rounds of quantitative easing, pandemic stimulus, and the systematic rise of passive investing. In that environment, any strategy that embraced volatility, ignored fundamentals, and maximized exposure won by default. Dave didn't pick winners. Dave didn't develop edge. Dave maximized his beta at the exact moment in history when maximizing beta was the optimal move. And he did it entirely by accident because he didn't know what beta was. This is the Dunning-Kruger effect operating not just at the individual level, but at a systemic, market-wide scale. Dave looks at his returns, draws a direct line between his decisions and his outcomes, and concludes that he is skilled. Dave does not consider the alternative explanation that the entire market has been on a 17-year bull run and that a dartboard would have generated similar results. Warren Buffett, the actual Warren Buffett, not the version Dave thinks he is, has been sitting on $350 billion in cash for the past 2 years. Not because he's scared, because he can read a valuation. But Dave is not thinking about Buffett's cash position. Dave is thinking about his next trade. And frankly, given where the market has been, Dave has been right, until he wasn't. Here is the part of this story that nobody wants to hear. The part that turns the Dunning-Kruger effect from a curiosity into something genuinely dangerous. High beta cuts both ways. In a rising market, Dave's high beta portfolio makes him look like George Soros. Dave is booking a table at Nobu. Dave is researching boats. In a falling market, that exact same high beta portfolio doesn't just lose what the market loses, it loses more, faster, and it keeps losing after the broader market has stabilized. Because meme coins don't fall 40% and recover. They don't fall 70% and recover. They go to zero, and they stay there. Zero-day options expire worthless. Pre-revenue biotech stocks that ran 300% on hype come back down to where they started and then go lower because the hype was the only thing holding them up. Dave is no longer researching boats. Dave is quietly checking if Payway is hiring. And this is not a story specific to Dave. This is what happens to every version of Dave, in every cycle, without exception, because the math doesn't change just because the name on the brokerage account does. Which brings us to the question that actually matters for anyone watching this right now. We have been in a generational bull market for 17 years, but bull markets don't last forever. They never have. And when this one ends, the Dunning-Kruger dynamic doesn't just reverse. It accelerates in the opposite direction. High beta strategies don't give back their gains on the way down. They give back more than their gains. Faster than anyone expects, and faster than most people can exit. The investors who have been winning for the past 17 years by doing the dumbest, highest beta, most irresponsible things, those are exactly the investors who are most exposed when the environment changes. And the environment always changes. So how do you actually prepare for this? There are two real options, and I'm going to be honest about both of them. Option 1, do what Warren Buffett has actually been doing. Sit on cash. Wait. Be patient. Accept that you might underperform for a year or two while you wait for genuine opportunity to appear. This is the correct answer from a pure risk management perspective. It is also the boring answer, and most people, including most professionals, will not do it, because underperforming in a bull market feels like losing even when it isn't. Option 2, keep going. Keep riding high beta. Keep buying the meme coins and the 0 days and the leveraged plays. But if you choose option 2, actually choose it consciously with eyes open, then you need two things that most high beta investors currently don't have. Number 1, a real exit plan. Not, I'll sell when it stops going up. A specific price level, a specific time horizon, a specific trigger that gets you out before the drawdown becomes unrecoverable. Number 2. The self-awareness to understand that your returns so far have been produced by the market environment, not by your skill, and that when the environment changes, the strategy that made you look like a genius will make you look like Dave. If you can't answer the question, who is buying my high beta positions from me when the market turns, then you're already Dave. You just haven't found out yet. So the next time your friend tells you about their 10-bagger meme coin, the correct response is not to be impressed, and the correct response is not to be dismissive. The correct response is to ask them one question: what's your exit? Because everyone is a genius in a bull market. The only question that separates the investors who survive from the ones who end up Googling payway hiring near me is whether they knew that going in. What's your exit plan? Drop it in the comments. I want to see who's actually thought about this.